Quick question. What would you pay for a business? If you're a real estate investor, you probably want your rent to pay back the building in 9 years. Maybe 12 if it's a great location. That's an 8 to 11% return. Reasonable. If you're a private equity firm buying a company, you're looking at maybe 8 to 12 times earnings. You want your money back in under a decade. Now, what if I told you there's a $65 billion company that just spent $1.2 billion buying its own stock at 31 times earnings? That's a 31-year payback, 3.2% implied return. In a year when T-bills, the most boring investment on earth, paid 4.5% risk-free, they literally got a worse deal than doing nothing. Welcome to Levels of Jackassery, a new series where we take companies roughly the same size as Strategy, the Bitcoin treasury company, and ask who's actually making smarter capital allocation decisions. First up, Motorola Solutions, $65 billion market cap, public safety darling, 23,000 employees. Wall Street loves them. Let's see if they should. All right, let's give credit where it's due. This is a real company making real money. Revenue, $11.7 billion, growing 8%. They sell radios, body cameras, dispatch software, and surveillance tech to police departments, fire departments, and government agencies worldwide. Their backlog is $14.7 billion. That's more than a year of revenue already locked in. Operating margins, 29%. Free cash flow in 2024, $2.1 billion. Record numbers. They have 23,000 employees, 40% of whom are engineers. They spend nearly $1 billion a year on R&D. They've made 48 acquisitions. They are, by any traditional measure, a well-run company. So what's the problem? The problem is what they do with the money once they make it. Since 2011, Motorola Solutions has spent $16.9 billion buying back its own stock. They completed the entire authorization. 229 million shares repurchased. In 2025 alone, they spent $1.2 billion on buybacks. They also paid $728 million in dividends. And, this is the fun part, they simultaneously borrowed $3.5 billion to buy another company. So let me get this straight. In the same year, they spent $1.2 billion buying their own stock at 31 times earnings, paid $728 million in dividends, borrowed $3.5 billion to acquire Silvus Technologies for $4.4 billion, and issued $2 billion in new long-term notes and $1.5 billion in term loans. They are borrowing money to make acquisitions while simultaneously burning money on buybacks at record high valuations. That is not capital allocation. That is a financial Rube Goldberg machine. Let me make this visceral because I think people miss how absurd buybacks at these multiples are. When you buy back stock at 31 times earnings, you are paying 31 years of profits for one share. That's the payback period. Let me put that in terms every investor understands. Good real estate, 9 years to pay back the building from rent, 11% cap rate, you'd take that deal all day? Decent real estate, 12 years, 8%, solid. A private equity acquisition, 8 to 12 times EBITDA. You're buying a whole company and getting your money back in under a decade. Motorola Solutions buying its own stock, 31 years, 3.2% implied return. And the kicker? Treasury bills, the safest, most boring, zero-effort investment available, paid 4.5% in 2025. They spent $1.2 billion on a 3.2% return when they could have earned 4.5% doing literally nothing. They paid more to get less. No small business owner would buy a company at 31 years of earnings. No real estate investor would accept a 31-year payback. But Greg Brown's board approved it every single quarter. Why? We'll get to that. Let's talk about Greg Brown. He's been CEO since 2011. He's clearly talented. The company has grown under his leadership. But talent and alignment aren't the same thing. Greg Brown's total compensation in 2024, $31 million. That's $1.35 million salary, $4.6 million bonus, $17 million in stock awards, and $8 million in options. His total ownership of Motorola Solutions, 76,000 shares. At today's price, that's about $30 million. Let that sink in. His one-year pay is worth roughly the same as his entire stake in the company. He earns in 12 months what he owns in total, and he's been selling. In November 2024, he sold $13.8 million worth of MSI stock, more in August 2025. The company just boosted his pay package in April 2026 with even more stock awards to, quote, retain him. Retain him from what? Running off with his $30 million in stock? He makes that every year anyway. Now let's look at the other side. Michael Saylor, Executive Chairman of Strategy, $1 per year salary, not $1 million, not $100,000, $1. He owns 19.9 million shares, 9.9% of the company. Class B shares with 10 votes each, giving him 45% voting control. At current prices, his stake is worth over $6 billion. He cannot meaningfully sell without collapsing the thesis and his own net worth. His incentive? The stock goes up, he gets richer, same as you. Perfectly aligned. Fong Lei, the CEO, $1 million salary, $880,000 bonus, and $13.4 million in equity awards, total $15.7 million, heavily equity weighted. His upside comes from the stock performing, not from hitting short-term EPS targets. Now compare. Brown makes $31 million per year, owns 0.24% of MSI, and actively sells shares. Saylor makes $1 per year, owns 9.9%, and literally can't sell without destroying his voting control. Charlie Munger said it. Show me the incentive, I'll show you the outcome. Now let's play my favorite game. What if they'd done something, anything else with that buyback money? Scenario 1. What if Motorola had simply put their buyback capital into treasury bills, not Bitcoin, not a hedge fund, T-bills, the financial equivalent of stuffing cash under a very boring, very safe mattress. Over the last 5 years, 2021 to 2025, they spent roughly $5.4 billion on buybacks. If they'd put that into T-bills instead, compounding at the prevailing rates each year, they'd have about $6.1 billion today. A liquid safe war chest sitting there ready for anything. Over 10 years, they spent $12 billion. Compounded in T-bills, that's over $14 billion today. $14 billion in liquid capital. That's more than their total debt. That's a Berkshire-level treasury. That's the ability to buy any company they want without borrowing a dime. That's optionality. Instead, they have fewer shares outstanding and $8.9 billion in debt. They burn the optionality to make EPS look better on a quarterly slide deck. Scenario 2, and this is where it gets fun. August 2020, Michael Saylor goes on every podcast, every conference, every interview and explains his thesis. Fiat cash is a melting ice cube. Bitcoin is the hardest monetary asset. Corporations should convert treasury reserves into BTC. He laid out the entire playbook, publicly, for free. What if Motorola Solutions had listened? What if they'd taken just 25% of their buyback capital starting in 2021 and bought Bitcoin? Not 50%. Not all of it, just a quarter. 25% of their buybacks from 2021 to 2025 is $1.36 billion deployed into Bitcoin. At the average BTC prices, they'd have been buying at each year. 29,000 in 2021, 47 in 2022, 16.5 in 2023, 42 in 2024, 94 in 2025. They'd have accumulated approximately 40,700 Bitcoin, 40,000 BTC. At today's price of about $104,000 per coin, that's worth $4.2 billion, a 3.1x return on invested capital. And they'd still have had 75% of their buyback budget for dividends, share repurchases, and M&A. What about 50% into Bitcoin? 81,000 BTC, $8.5 billion in value, more than their total debt, a liquid treasury asset that appreciates while they sleep. Instead, they bought their own stock at 31 times earnings and got a 3.2% implied return. The Bitcoin basket would have returned 210%. Same 5 years, same capital, wildly different outcome. Let's talk about what they actually did with their debt capacity. In 2025, Motorola Solutions acquired Silvus Technologies for $4.4 billion. Silvus makes mobile networking hardware for military and public safety. Cool product, reasonable fit. How'd they pay for it? $2 billion in new long-term senior notes, $1.5 billion in new term loans, the rest from existing cash. So they borrowed $3.5 billion to buy a hardware company. Their total debt went from around $4.5 billion to nearly $9 billion. Debt-to-equity ratio, 3.9 times. Long-term debt fair value, $8.9 billion. In the same year, they spent $1.2 billion on buybacks. So the board decided borrow billions at market rates to acquire a company, while simultaneously spending billions buying our own stock at 31 times earnings. One hand is loading up the credit card, the other hand is burning cash. Imagine doing this in your personal finances. Take out a second mortgage to buy a rental property, while also paying 31 years of rent up front on an apartment you already own. Your financial advisor would stage an intervention. Now let's count the risks that MSI shareholders carry. This is the part that should bother you if you own this stock and think it's safe. 1. $8.9 billion in debt, 3.9 times debt to equity. 2. Government budget dependency. Their revenue is tied to multi-year public contracts that are subject to political cycles, budget cuts, and procurement rules. 3. The UK airwave charge control. The British government literally regulated their pricing down and won in court. This can happen anywhere a government is your customer. 4. The Axon ecosystem war. Axon is attacking from body cameras into CAD and dispatch. MSI is defending from radios into video and software. Full-scale platform competition. 5. LMR obsolescence. Their core radio business is built on land mobile radio. Broadband and 5G are slowly eroding that moat. 6. AI and biometrics regulation. Cities are banning facial recognition. Surveillance tech faces increasing legislative pushback. 7. The acquisition treadmill. 48 acquisitions. Each one adds integration risk. 8. 23,000 employees. That's over $1 billion in annual payroll. 9. $970 million per year in R&D just to stay current. 10. Physical hardware and supply chain risks. 11. Free cash flow growth just went negative 258% in Q4 2025. 12. The stock is already down 20% from its all-time high. 12 categories of risk. 12 ways this story can get worse without a single extraordinary event. Now let's count strategies risks. 1. Does Bitcoin continue to monetize globally? That's it. That's the list. Okay, fine. There are secondary risks. Capital markets access. Can they keep issuing? Bitcoin volatility. Can they stomach the drawdowns? Software business attrition. Does it matter at scale? But fundamentally, strategy is making one bet on one asset with one thesis. Bitcoin is the best long-term treasury reserve in the world. If that's right, everything works. If it's wrong, it doesn't. The question for you as an investor is, which risk profile do you actually prefer? 12 hidden fragilities that compound over time and depend on government budgets, technology cycles, acquisition execution, regulatory whims, and a CEO who's cashing out. Or one concentrated bet on a liquid monetary asset managed by people whose entire wealth is tied to your outcome. Markets call the first one safe and the second one speculative. But I'm not sure they're counting all the risks correctly. Let me leave you with this table. Print it out, put it on your wall, show it to anyone who tells you buybacks are returning value to shareholders. A good real estate deal pays for itself in 9 years. 11% return. A PE acquisition, 10 years. 10%. Treasury bills in 2025, immediate. 4.5%. Risk-free. MSI buying its own stock at 31 times 31 years, 3.2%, with 12 categories of execution risk attached. Strategy buying Bitcoin with STRC capital at a 10% cost. If BTC compounds at 20 to 30%, the spread is 10 to 20% annual. Payback in 3 to 5 years. One category of risk. The math isn't complicated. The incentives are just misaligned. Management gets paid for buybacks. Shareholders get paid for good capital allocation. When those two things are different, guess who wins? Show me the incentive. I'll show you the outcome. Let's put it all side by side. Same market cap. Two completely different animals. Motorola Solutions, $65 billion market cap, 23,000 employees, $11.7 billion in revenue, $8.9 billion in debt, most of it used for acquisitions and buybacks. CEO makes $31 million, owns 0.24%, and sells regularly. $16.9 billion in buybacks completed. No treasury asset. Strategy, $63 to $65 billion market cap, 1,500 employees, $470 million in software revenue, Debt is convertible notes and preferred stock. Non-traditional, no maturity walls. Executive chairman makes $1, owns 9.9%, and can't sell. 818,000 Bitcoin worth 64 billion. The treasury is the company. One company has a CEO aligned with quarterly metrics. The other has leadership aligned with generational wealth creation. One company borrows to buy hardware companies and its own stock. The other borrows to buy the hardest monetary asset on earth. Same size, same market. Very different jackassery levels. Look, I'm not telling you MSI is a bad company. It's not. It makes real products for real customers in a critical industry. First responders depend on their equipment. That matters. But when we're talking about capital allocation, what management does with the cash the business generates, the comparison is brutal. They spent $16.9 billion on buybacks, most of it at elevated multiples. They spent $4.4 billion on one acquisition funded with debt. Their CEO makes $31 million a year and owns less than 0.25%. If they'd put just 1/4 of their buyback capital into Bitcoin since 2021, they'd have $4 billion in liquid treasury assets right now. If they'd put it in T-bills, they'd have $6 billion in war chest. Instead, they have fewer shares and a pile of debt. This is what happens when incentives drive behavior instead of the other way around. The buyback machine runs because it's what the market expects, what the board rewards, and what makes the comp targets achievable, not because it's the best use of capital at these prices. 31 times earnings, 31-year payback, 3.2% return, in a world where T-bills pay more. That's the first level of jackassery. Next week, we find another one. Same market cap as strategy, same game, different victim. I'm lucky. See you then.